It was a pretty uneventful day on Wall Street with the S&P 500 advancing only 0.17%. However, the real fireworks happened outside of the stock market. In particular, the US dollar really fell apart here today, which allowed things like gold and oil to really start surging to the upside, and that carried over to a number of those gold mining companies like the one we talked about a week ago, which was Kirkland Lake. And we also saw that oil companies, stocks like Chevron and Exxon, really had a nice day here today, kind of out of the blue as well. So we'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a company that just announced a dividend increase here tonight after the bell, and it might be setting up for an interesting sold put opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 21st, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe while you're over there. Check out our email distribution list, which you'll see posted in the description area. Get yourself signed up for that, so that way you can be alerted anytime we post these videos, which also gives you the heads up on what stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me there for daily commentary in terms of the things I'm thinking about with the stock market between classes and these YouTube presentations. We do appreciate those of you that click like and retweet on these posts that have to do with the Market Outlook video. And then lastly, we do have a presence over on Facebook as well. Feel free to join our group at the web address you see embedded in that logo in front of you. All right, let's go ahead and jump into the charts. And as you can see, I've got chart 4B pulled up here. And as I mentioned in the intro, bit of a quiet day, not a whole lot of waves out there. S&P 500 was up 0.17% today. I think the big takeaway from this grid view today is the fact that it was kind of opposite day as yesterday. In other words, yesterday we saw the resurgence of the NASDAQ and those technology-oriented companies, particularly the work from home and maybe some of those biotech types of companies. Today, we saw the opposite. Today, we were back to those oil companies that I mentioned, Exxon and Chevron, and then also a bunch of the banks. Wells Fargo and JP Morgan had nice days. We saw some of the industrials like Raytheon and Boeing, Lockheed Martin having nice days. So today was kind of one of those more old line company days, and the NASDAQ took a rare back seat. You can see that the NASDAQ composite actually closed in the red by a pretty healthy margin. We were down 0.81% today on the NASDAQ, and we closed near the lows of the session for that index. Now, keep in mind, we did just hit an all-time high this morning, so it's not as though this is a broken trend or anything along those lines. I don't want this to sound alarmist or anything. It was just, hey, one bad day, and when you're winning as often as the NASDAQ has, you can afford to have a few bad days here and there. So anyway, it looks like the NASDAQ was the underperformer today. Big winner today was actually Russell 2000. It was up 1.33%, and you can see that kind of pushed the Russell 2000 index up and through its prior resistance from back here on July 15th. So that was impressive there as well. The S&P 500 was also able to do that, but we did not see that out of the Dow Jones or the NASDAQ composite. So impressive day there for the small caps. Now, as you can probably see here, we do continue to have bullish postures across the board on all four of these indices. Remember, the easiest way for you as the viewer to understand that is just simply look at the color background of the charts when I'm displaying this particular view on chart 4B. If the background color is dark green, like it is in all four of our charts cases, that means we have strongly bullish postures on all four charts. With the Russell 2000, you'll notice that 2 or 3 days ago it was this light green color, telling us that we had a weakly bullish posture, but we did resort back to a strongly bullish posture in the last couple of days, and today helped that cause. Now, you will notice that both the Dow Jones Industrial Average and the Russell 2000 both have yellow 30-day moving averages on this particular chart. And as a reminder of what that means, it basically means that price, in this case, is above a falling moving average. Remember, if the moving average tips are green, like they are in the case of the S&P 500 and the NASDAQ Composite, it means price is above a rising moving average. If you ever see those moving average tips red, it means that price is below a falling moving average. If you see yellow, like we see in the case with the Dow and the Russell 2000, it means there's a little bit of a conflict in there. One of the things, price is bullish, in other words, above a moving average, but the other thing, the moving average itself, is actually pushing lower, so there's a little bit of a conflict there. And remember, it can happen on the opposite side as well. If you ever have a situation where the moving average is going up, but price is below that, it would also be yellow in that case. So just be aware that from kind of an intermediate perspective, you do still see that the S&P 500 and the NASDAQ Composite would be considered stronger from those perspectives. And again, a big reason behind that is what is the leadership of this market, or what has it been? It had been those big technology-oriented companies like your Apples, Microsofts, Amazons, Alphabets, Facebooks. All those types of companies have been roaring for not just recently, but for years at this point. All right, let's go ahead and take a look at our 3 green arrows setup now. And that will be chart 4D for those of you that are following along at home. And remember, on this particular setup, when you see the background colors, that will distinguish between 3 green arrows, 3 red arrows, or a mix of green and red arrows. So just like on the last setup, all of our charts are exhibiting a similar characteristic in that the background colors over all 4 charts currently is green, telling us that we actually have 3 green arrows on all 4 of these charts at this moment in time. For those of you that are newer to that idea, some of you have been with David and I many, many years, even with the company we used to work for, so you're probably familiar with that terminology. But in case you're somewhat new to these videos, 3 green arrows is just simply a way to take 3 different technical indicators and try to determine if they are considered bullish or bearish at that moment in time for trend trading purposes. And the 3 technical indicators that we look at for this particular setup would be the 30-day moving average itself. When price is above it, it has a green arrow. Like in the case here with the S&P 500, we went above that moving average back here on June 30th, and we've stayed above there ever since. So that has retained that green arrow. The next arrow that we ask ourselves about is the MACD histogram. And the MACD histogram is effective in locating where we have momentum for a security. And if there is positive price momentum, we see that 0 crossover there to produce that green arrow. And as long as that momentum continues, it continues to offer that green arrow, which has been the case on the S&P 500 since July 6th. And then the third and final arrow that we are seeking out is on the stochastic. And the stochastic is a way to measure where is a stock currently in relationship to a particular range of time. And if a stock is trading in the upper half of its range, typically it is viewed as a bullish characteristic, and that is the case here as we had what's known as a phantom green arrow on the stochastic for the S&P 500 back here on June 30th. So that's why you see starting right at this point on the chart, the background color is that greenish color because it was on that day where we got our third and final green arrow, and we've continued to have that 3 green arrow set up ever since. So with the S&P 500, we've actually had the 3 green arrows set up the longest amount of time. That occurred back on July 6th. With the Dow Jones, we received our 3 green arrow signal here on July 14th. On the NASDAQ Composite, we actually just got it yesterday because for a while there we had a couple of red arrows that emerged in there when we had a little bit of a sell-off in the NASDAQ, but we're back in that mode again right now. And then on the Russell 2000, we got our 3 green arrows set up there on July 15th. And you can see for the most part, while the momentum or the trajectory of this market may not be quite as steep as what we saw coming out of the bottom in March and April, for the most part, the trends are still intact. We continue to be supported by, of course, federal stimulus. There's more rumors floating around that the next stimulus checks will be popping into people's mailboxes sooner rather than later, and I imagine there will be some motivation by the current administration to get that done before the election as well. So there's always that possibility that that money finds itself going back into the economy to help support stocks. And at this point, it's all systems go to the upside. But obviously, that can change, and it can change quickly in this type of an environment. And so that's why David and I try to do these videos as often as possible. Remember, if you want us to do these videos every single trading day, I would encourage you to click like and retweet for us there on Twitter. That's our way to judge whether you guys are finding value out of these videos or not. If you're not finding value out of them, then David and I, of course, can find other things to do with our time as well. So we would just encourage you, as most of you do, and we appreciate to stay consistent with that as well, because we just want to make sure that our time is being used the proper way, and you guys are getting value out of the time you're spending with us. All right, let's go ahead and take a look here now at our 1040 crossover method chart. That's going to be 4C. Again, the same four indices that we're looking at here. In this particular case, what makes this particular 4 grid different than the other two I just talked about is these are longer term views. Each one of these charts you see in front of you are 3 years in length, and each one of the candles you see are 1 week in length. So it's not as sensitive, I guess you would say, as the other charts we've been looking at that the candles are represented by 1 day. In this case, it's 1 week. And so going back over the last 3 years, you can see that it's been mostly a good place to be investing in the last 3 years. Now, the exception to that, I guess, would be the Russell 2000. Russell 2000 is pretty much flat over the last 3 years. You've had kind of this big move lower and then a nice bounce off the lows, but it pretty much just puts us back into place into some of these areas that we were trading about 3 years ago. We're up a little bit over that time period, but it's only 4%. Whereas when you look at where are the big returns over the last 3 years, take a look at the NASDAQ composite. Up 67% in 3 years' time. Remember, traditionally, the stock market only delivers about 8 to 10% annualized returns if you go back over history. That's if you're looking at the S&P 500. Obviously, the NASDAQ composite is notorious for having a lot more growth-oriented and technology-oriented names, so it is a different animal, but just gives you a sense of how good we've had it as investors here, at least in the United States, over the last 3 years, when you have one of the major indexes out there giving you a 67% return in just 3 years' time. And during that time, we've had a global pandemic that sent the stock market down over 30%, yet we still have those types of returns. So without a doubt, this is as I was telling my class today, this is technology's world, and we're all just living in it, right? This is a market that is being driven higher by the workhorses, and those workhorses in this day and age are technology oriented, and so that's showing itself up there in the NASDAQ composite. Now you'll notice I do have some new information to share with you on this particular chart setup. We've got to be careful because it is only Tuesday, and with this looking at weekly candles, this candle is not set into place until Friday afternoon when the market closes. But as of this moment in time, we do have a bullish crossover on the Dow Jones Industrial Average. Now, for those of you new to looking at this chart, the different color schemes that you see on the background here will represent whether we have a bullish posture or a bearish posture on the crossover method. And the orange lines that you see on the chart are the 10-week moving averages, since we're using a 3-year weekly chart view here. So this is a 10-week moving average. That would equate to about 50 trading days. And then you've got a 40-week moving average represented by the blue line, and that would represent about 200 trading days. And so when you see the more sensitive line, in this case the orange line, cross up and through the blue line, you get what's known as a golden cross. And that is what is taking place right now. But again, I must caution you that it is possible that if the stock market were to collapse here in the next 2 or 3 days, that this particular crossover may not exist at the end of the week. But right now, it's looking pretty promising, and that's a good sign, because that would at that point mean that 3 out of our 4 charts are back to those bullish crossovers despite the very difficult circumstances of the coronavirus. And even the Russell 2000 is not far away. We might be talking about that crossover here within just the next few weeks as well. So positive signs there for the longer term investor as well. All right, let's go ahead and take a look at some 12 grid analysis now, starting with the asset classes, where we do have a number of things to discuss here today. As mentioned in the intro, one of the big stories, at least from my perspective today, was the US dollar. That's the chart in the lower left-hand corner here. You'll see the UUP was down 0.62%. And while that might not sound like a lot to some of you, remember that we're talking about trillions of dollars of back and forth trading that take place in something as large as the US dollar. So a 0.62% move is actually a pretty big move. In fact, you could look at the size of the candle here today and compare it to all of these other candles before it. And the only other one, as I'm going backwards, that looks equivalent to it is probably back here on June 15th. So it's been over a month since we've had a candle as aggressive as this one. And this has been in a downtrend for some time. In fact, I don't remember if it was last week or the week before, but I made the comment during this presentation that for a brief period of time, it had a weekly bullish posture. The background color of the chart was light green, but I said, I don't know how much I would trust that, considering we are still below a falling moving average. So it's not something that you should get too aggressive taking action on. And now you can see why I would have made that statement, because it was just a brief 1 or 2 day pop over to the weekly bullish posture, and then we were right back to a strongly bearish posture as we kicked down off of that falling moving average. And today we actually hit multi-month lows. Notice that we easily eclipsed these lows that were set back here on June 10th with today's move. Now, as all of you should be aware, as long as you've been loyal followers of these videos of David and I's over time, when the US dollar is weak, you have this opportunity in commodities, and you also have an opportunity in foreign investments. And you also sometimes have those opportunities in multinational stocks that happen to be headquartered in the United States. So, as you can see, the chart to the right of the US dollar is gold. And as you guys know, I've been talking about gold over and over and over again. You're probably getting sick of it, but it continues to work. And I do have positive news on that front. I believe it was in the video I did just a week ago, last Tuesday, where we bought that Kirkland Lake Gold, ticker symbol KL, and we actually were able to get out of that at max gain here just today. So we bought it on that candle, since it would have been placed the next day after my video, and just a couple of sessions later, max gain as this one hit a new multi-month high there on Kirkland Lake Gold. So that represented a lot of those gold mining companies because GLD itself, which is kind of what drives those mining companies, was up 1.2%. Remember, for GLD, this is a multi-year high, not just a multi-month high. Let me show you as I maximize the sell for GLD, which represents the pathway of a price of an ounce of gold, but to do it in an ETF form. If I were to go back and show you a 10-year chart now instead of a 3-month chart, you can see that with today's move, we are now back up to basically this candle right here. This would have been back in October, the first week of October of 2012. So we're talking about 7-year highs, almost 8-year highs with today's move. That has been an aggressive and a wonderful trend to be trading, and we have repeatedly in this particular presentations, not just through GLD itself, but also through GDX, GDXJ, Goldfields, Newmont Mining, the Kirkland Lake that I just mentioned. So we've had a lot of bullish gold trades that have really benefited in our trade application examples. And right now, I don't know if I see a reason why we should pull away from that trend. This is a very strong trend that's in place here, and we are in the type of environment right now where inflation could very well be rearing its head because of all of the money printing that's taking place and money being pushed into the market in addition to the falling US dollar. In fact, in my top-down trend trading class just yesterday, for those of you that are premium members, you'll know that we bought a different gold mining stock, and it was up like 4% here today as well. So that's a theme that I think many of you have been on top of, and hopefully you've benefited from as well. But today was another wonderful day for gold mining and gold itself. Now, oil, you can see is the chart just to the right of that. So this one I'm kind of circling right here. It didn't have as clean of a breakout here today as what we saw on gold, but it was still a substantial day. You can see that we were able to get up and over some of these prior resistance zones, even if USO was only up 2%. However, that did find its way into the energy stocks. We'll talk about that when we look at our sectors here in just a little bit. But that's another area where if you're looking for more of a catch-up type of a trade, maybe there's going to be some opportunities there. Some of you might have seen the news yesterday where Chevron is buying out Noble Energy. So maybe we start getting some merger and acquisition activity in the oil patch that can start adding to some returns there as well. Now you'll notice that the EEM was the star from the stock perspective today. So foreign stocks emerging is what we're talking about when I say EEM. It was up 0.92% here today, which did beat the developed markets in the United States and the developed foreign markets that were out there. So again, remember when the US dollar is falling, that can help support prices in the foreign markets. And while we didn't necessarily see that in a big way in the developed foreign markets, we did definitely see that outperformance in the emerging foreign stocks here today. So positive performance there. And then foreign bonds also outperformed U.S. bonds here today, at least U.S. government bonds. So BNDX is this chart kind of in the middle here. You can see we went to yet again more multi-month highs there in BNDX, which tracks foreign bonds. It was up 0.1% here today and remains in a very healthy uptrend. Let's take a look at our sectors now. Moving on over here to chart 5C, the U.S. sectors 12 grid. And remember, this is the market cap weighted version. For our premium members, we also have a separate 12 grid that will track the equal weighted version, which is slightly different, but this will kind of give a little bit more emphasis to your Amazons and your Exxons and Chevrons of the world. And speaking of which, you can see today's outstanding performer by a long shot was XLE, and that tracks energy stocks. It was up 6% today. That's a massive move because of Exxon and Chevron and a number of those others benefiting from the rising price of oil. However, before we get too excited about it, let's also remind ourselves that energy has struggled for so long that even a 6% move doesn't really do much to get people excited about it. We're basically just right back up to this falling moving average at this point, and so it's entirely possible that it might just roll over right here. Then again, as I right click and go to maximize sell, one thing I did want to point out here is it kind of gives us the impression of an inverted head and shoulders pattern with this little formation right here, the left shoulder, this little formation over here, the right shoulder, and this formation in the middle, the head. And the idea behind that is it's a reversal pattern where the expectation would be a move to the upside, and your price target would basically be the length between the head and the neckline. And so you might be able to see it kind of rise back up into some of this area that we saw back here on June 19th, if that is your expectation. But we got to be careful with that again because of what I mentioned. We are sitting right at a resistance area right here. So you can't necessarily just assume that's going to happen. But at least there's some support for those of you that want to have a bullish thesis on energy right now. The other thing I would point out is we're back to a bullish bullish posture from a market forecast perspective, because on the market forecast indicator, that green line, the intermediate line there, has now emerged out of the low reversal zone. So notice right there, that green line is now just a hair above 20. It's at 22.82 and rising, and that's why the background color has now switched to that light green color, because we have gone from having a bearish posture on it to now a bullish posture after today's big move, which means that the real estate sector is the only one that remains with a bearish posture. Remember, on Thursday, both energy and real estate had bearish postures. With energy's big move today, it's now gone to a bullish posture. Real estate stays with a bearish posture. Real estate barely even budged today. It was up 0.03% today, so yet again an underperformer there, and is struggling with some resistance in this area right here. Because of the underperformance of the NASDAQ today, you shouldn't be surprised to learn that communications and technology were both down today. Communications was down 0.5%, and technology was down 1%. So those are kind of our lagging areas here today. Once again, this is a market today that was kind of led by old line companies, whereas yesterday was led by the new technology and internet-oriented names. Real quick over here on the internet, the sector selector that I put together last Friday evening does show a nice emergence out of materials. Materials have made their way all the way up to number 2. That's something that I've been kind of talking about in these videos as well, that materials have actually shown some of the best 1-month performance out there. And remember, the gold mining companies are part of that. They're a pretty small part of it, to be fair, but nonetheless, they do aid the materials in general right there. And that was an area that we focused on yesterday in my top-down trend trading class. You will see that technology fell out of the top 3, so that was somewhat noteworthy as well. We'll see if they can get back in the top 3 here after the NASDAQ had a big rally yesterday, but it seems like they're kind of going back and forth and not quite as consistently strong as they had been beforehand. Also, while I'm over here on the internet, just a friendly thank you to those of you that clicked like the last time that I did the video. Looks like 116 of you did it, so I'd like to see those up and over 100, and I really appreciate those of you that do that consistently day in and day out to let David and I know that you'd like us to do these videos, if possible, every trading day. We might not be able to do that every day, but if we know you guys like these videos and are supporting them, then the pressure is on us to do them every day. If you guys don't support us on social media, then we'll get the gist that maybe you don't want them, and then the pressure won't be quite as strong for us to do them every single day. So if you want us to do them every day, make sure you're doing your part, helping support us on social media there, and you guys have done a great job with that. Earlier today, I taught my dividend growth investing class, where we did concentrate on the communication sector for our head-to-head matchup. So if you're interested in what stock we added to our dividend growth investing portfolio from that sector, feel free to come up to our trading rooms area and click on that recording that is already available for you. And then David taught his directional option strategy class earlier today as well. Tomorrow morning, I'll kick things off with my factor-based swing trading class, where we had quite the lucky set of circumstances in the last 48 hours in that particular class, and I'll explain that to you guys that are in class tomorrow morning. All right, let's go ahead and now talk about our trade application example for the day. And I wanted to bring up a stock that just had a news story hit after hours here today, and that is JM Smucker. And it says, JM Smucker raises quarterly dividend to 90 cents per share. Now, it was at 88 cents prior to that, so it's not a huge boost or anything like that. But remember, this is an environment right now that we find ourselves in where the stock market is strong, but the economy is still weak. And in that type of an environment, you are finding more and more companies deciding not to raise their dividends, or basically keeping the dividend at the same rate. Now, we've seen a number of stocks that have cut their dividends this year, over 100 of them have, but we've also seen a handful that have raised them, but I would say that the majority of them are kind of in that middle ground where they're just waiting for further information before they make a decision about their dividend policy. So when we see a few of these brave ones here and there, like Smucker and Procter & Gamble and Johnson & Johnson, that bravely come out and say, you know what, our conditions are strong enough right now to raise the dividend, I think that's making a bit of a statement. And of course, during the pandemic, a lot of people were heading down to their local grocery store and loading up on peanut butter and jelly and Folgers coffee and other things that Smucker's makes. And so I'm going to try to place a bullish trade on it for this particular trade application example. You'll notice as I pull up, let's say, chart 3A, which is our swing trading chart, that Smucker really hasn't done much of anything here recently, and that's pretty common. Smucker, as you can imagine, is a pretty boring company. But there was one indication here today that I'll bring up that is worth pointing out, and that is we just went from a bearish posture from a near-term perspective yesterday to a bullish posture from a near-term perspective today. And that occurs when the blue line ticks higher like it did just here yesterday. We also have the intermediate line bullish. That's the one we talk about a little bit more often in these videos. That's the green line, and that is also pointing higher. But, to be fair, this is a pretty sideways looking chart, but it was nice to see us close slightly above that downtrending moving average today. And hopefully that can start supporting it to rebase that to the upside here going forward. So what I thought we would do today is a sold put opportunity on this one. Coming on over here to our trade tab, you can see that as I look at the August contracts, they have 31 days until expiration. That's another thing I wanted to point out, is that Smucker is one of those off-cycle earnings reporting companies. You can see the last time they reported was back here on June 4th. So that means that they probably won't report earnings again until around September 4th. In other words, the options expiration will have already occurred by the time they report their next earnings, which eliminates that possibility of a big gap against your trade. So it's going to be kind of just driven by its own organic trading setups along the way and not being forced around by an earnings announcement. So what I thought we would do here today is focus on the 100 strike put. You can see that that would offer up a return of about 1.5%. You can see that the last traded price for that today was $1.35, and so I think that's what we'll kind of target right there. The other thing that I would point out is that if you look at this on our dividend stair-step chart that we use for my dividend growth investing classes, Smucker is already an attractive candidate from an average high yield perspective, as it's trading kind of in the blue zone of this dividend stair-step chart, which from that average high yield theory suggests that this is an attractive time to be thinking about picking up shares for the long term. So let's go ahead and place that trade by clicking on the bid price there. And then I'm going to change this to $1.35, which is the last traded price for today. I will put this in as a good till cancel order because you just never know. Maybe it pops higher first thing tomorrow morning as people are digesting the news about the dividend increase. So it's possible it doesn't get filled first thing tomorrow. But if it fills me the day after or next week, I'll be happy with that as well. But remember what you're doing with this particular trade. This is a bullish trade where you're basically saying that you're committing yourself to buying the stock at $100 if it falls below there. So it's trading right now at $106.56. So you have a $6.56 head start on this trade. And if it stays above 100 for the next 31 days, then you keep the $135 that you're going to take in from this credit. If it does fall, let's say it falls from 106.56 down to, let's say, $99 on expiration day there in August, then you would be forced to buy 100 shares of this stock at 100, so it would be a $10,000 capital outlay. But of course, you could subtract out your premium that you receive for your kind of your true cost basis in that situation there as well. So let's go ahead, click confirm and send, and ship that off, and we'll see if we can get filled first thing in the morning. All right, thank you for joining me here yet again this evening. It was an interesting day in the stock market where we saw the small caps rising and the NASDAQ stocks really struggling, which is kind of reversed from what we saw just yesterday. So we'll see what tomorrow brings. But the good news is the trends on most of the indexes are still quite strong, and we are seeing strength in most sectors out there as well, including the energy sector that had a huge surge in price here today. So if you got value out of tonight's video, make sure you head on over to Twitter, click like for me over there. David should be back with you for his video tomorrow night. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.